Good afternoon, everyone. My name is Mike McNamara. I'm the Mutual of Enumclaw Field Professor of Insurance here at Washington State University. It's my pleasure to welcome you to the 29th Annual Walton Lecture. This lecture series has brought to our campus leaders in the field of risk management and insurance, and today's lecture will continue that fine tradition. The Walton Lecture is made possible through a generous endowment from the Independent Insurance Agents and Brokers of Washington. The endowment honors their past president, Mr. Max Walton. Mr. Walton was an independent insurance agent in Richland, Washington. This is the first of two programs that we have this week for our students. Tomorrow at 5 p.m., also via Zoom, we'll have our insurance industry night. Representatives from PEMCO, Liberty Mutual, Hub International Travelers, and some others will talk about careers in insurance and offer career advice for our students. I encourage all students to participate in tomorrow night's event as well. And now to today's lecture. COVID has impacted our lives in so many ways. For our students, it's meant a year and a half of Zoom lectures, vaccinations, and wearing masks to class. COVID has had a great impact on small businesses. On state and local fronts, we've had small businesses negatively impacted. Unemployment has spiked. And the travel and hospitality industries have been impacted especially hard. The global implications of the pandemic continue to register in foreign trade. It's rush hour down in Southern California, but the biggest traffic jam is actually off the coast, as more than 60 cargo ships are waiting to get into the ports. Ports in Savannah, Philadelphia, New Jersey, Tampa, New Orleans, and the Houston shipping channel have also reported long delays. Manufacturing has slowed due to lack of component parts. Closer to home, you probably have seen bare spaces in the shelves when you've gone shopping. To be blunt, the supply chain is in crisis at this time. Working to solve the supply chain problems of its clients is Seattle-based Expeditors, an international freight forwarding company. The company has graciously hosted student groups from Washington State in the past. What do they do? As a company official described their operations to me once, we move freight and we wear suits. Further, we're travel agents for international cargoes. Expeditors is fortunate to have as their risk manager today's speaker, Mr. Nathan Mallory. Nathan joined Expeditors in 2015 after working 8 years with a global insurance broker and 5 years with a local broker in the Seattle area. It's wonderful when the Walton Lecture is presented by one of our alums. Nathan is a 2002 graduate of Washington State University with a degree in business. Nathan's lecture is titled Supply Chain Risk in the COVID Era. After his presentation, we'll have time for some questions and answers. Students, I know you're familiar with the chat function. If you have questions during the lecture, please type them in the chat box, and we'll get to the questions after Nathan's remarks have concluded. After the session, we'll have a special gift presentation for our speaker. Ladies and gentlemen, please join me in welcoming our 2021 Walton Lecturer, Mr. Nathan Mallory. Nathan, the floor is all yours.
Well, Dr. McNamara, thank you so much for that intro. I have to say that I am extremely honored to be presenting to this group, and I'm very, very thankful and excited. First, let me thank you, Dr. McNamara, for all the work you do with the risk management and insurance program there at Washington State. I think a great deal of credit goes to you for keeping that program running and turning out some of the best professionals in the business. Also love to thank Washington State University and the Carson College of Business, Dean Chip Hunter, as well as the Finance and Management Department Chair, David Whidbey. Also, would like to thank the Independent Insurance Agents and Brokers of Washington for endowing this lecture to honor its past president, Max Walton, and to honor the great work he did as an agent. And also the IIABW for the great work they do for their agents and the consumers here in the state of Washington. I'm very, very lucky to be presenting to you today, and I wanted to make sure, as Professor McNamara mentioned, I'm one of you. I really am proud to say that I am a Cougar. I graduated in 2002, like Dr. McNamara said. I lived while I was on campus, maybe in some of the places you live. I lived in Stevenson North for a while. I lived in Boulder Creek for a while. And I played football while I was there. And now you probably have never heard of me. Now this is also many years ago, but we had some success while we were there, and I was lucky to be part of some great teams with some great people. We had a couple of bowl games while I was there. In 1998, we had the Rose Bowl, and in 2001, we had the Sun Bowl. So I wanted to show some video or some pictures of us and the team, me and the team, during that time. But I tried to find a team picture online. The only one I could find was of the Rose Bowl team, and it was black and white. And I thought that might not be a good idea to share that, because it will show you just how old I am. But I was able to grab a couple screenshots. They do have the 1998 Rose Bowl game on YouTube. I had to watch through this grainy video, but I did find myself a couple times, and this is my claim to fame. So as you can see in this screenshot here, that's not me, obviously. But if you look in the back, this guy here, that's me, number 92. I was a redshirt freshman. And my goal for this game, because I didn't have any responsibilities, my goal for this game was to, besides supporting my team, was to get on camera as much as possible. So I did. Here's another one of me. I stayed close to the sideline, and the camera found me, or I found the camera. But that was my claim to fame during that game. I came out of there with a couple of rings. Very happy, it was very cool to get those rings. I don't ever take them out. The only time I take them out is when I try to impress my kids, and that doesn't even work. But it's a great honor to have played with so many great guys. I played a little bit after college. My career was short-lived, but I knew at that point, after a little bit of time in the Arena League, that I was ready to hang it up and start my career. And it turns out my career was in insurance and risk management, lucky enough. I came home in 2003 after spending time with the Arizona Rattlers. And I started looking for my next job, for my career. And I was lucky enough to know somebody who worked for a large global insurance brokerage called Marsh McLennan. And I was able to start in a training program back in New York, and I spent about 7 years total at Marsh. Part of that time I was working in the private client group, which is a personalized insurance group, working for some high net worth families, some prominent families in the Northwest. Then I transitioned over to the commercial insurance brokerage, where I worked on several large, high-profile companies in the Northwest. And then in 2010, I was approached by a local, smaller, privately held brokerage called Smart Parker Smith and Feek, where I went and spent about 5 years before being approached by Expeditors and being presented with this opportunity. So what do I do for Expeditors? Professor McNamara gave you some idea of what I do there or here at Expeditors. I do work in the risk management department, so I am part of the management of the global insurance program. So basically the coverage for the global operation. I work within our risk management department. We house our claims team. So as Professor McNamara said, we are travel agents for freight. And if we handle freight globally, and of course, with such high volumes, you're going to have claims. And so our claims team here takes those claims and processes them and gets them paid, which is a great deal of volume, if you can imagine, with the hundreds of thousands of shipments en route or in process at any given time. I also work on our insurance brokerage side of our business. So we have an insurance brokerage called ECIB, Expeditors Cargo Insurance Brokers. Part of my responsibility is managing my team that is located in the Americas, US, Mexico, and Canada. We also have operations over in Europe, where we have another team that reports to somebody else. But we develop and manage products and services for our customers related to mitigating risk and addressing risk in the supply chain. So that would be insurance, that might be supply chain risk management, loss control, risk and mitigation techniques. So we advise our customers on those aspects of the business. I also should mention that there on the bottom, RIMS of Washington, I've been a board member for a few years now. I've spent time on the board on and off over the last 10 or 12 years. Great organization. Professor McNamara is involved as well. For those of you who to come out of Washington State and you are in a risk management or insurance role, I would highly recommend you look at the RIMS Washington chapter. There's also a Spokane chapter. Great resources, great group of people, and fantastic networking opportunities, in particular for the emerging risk professionals. I highly recommend it. Now, in terms of who we are, so Professor McNamara kind of let you know what we do, but I'll just kind of give you a couple other pieces of information. So we were founded in 1999. We are in Seattle, as you can see, with that beautiful backdrop. We have over 18,000 employees. So in my time here at Expeditors, I started in 2015. We had just over 14,000 when I started, and we have grown significantly since. In 2020, we had a revenue of 10.1 billion, which put us at number 299 on the Fortune 500 list. I mentioned ECIB, our cargo insurance brokerage. That stands again for Expeditors Cargo Insurance Brokers. The wholly owned subsidiary of Expeditors International, really a niche or specialty broker specializing in the supply chain, so cargo insurance, stock throughput, and we manage cargo claims. As you can imagine, it's very relevant to what we do as an overall company. As we move customers' goods, we also want to protect their goods, and that's where we come in. So I wanted to, so we're going to talk a little bit about supply chain risk today, but before we can't get too deep because we just don't have a ton of time, but we are going to tackle a few areas of supply chain risk. But I also wanted to kind of talk through some of the challenges we have going on in the transportation industry. COVID has affected our lives, and we're not immune to that in the transportation industry. I'm sure a lot of you on the call have experienced some form of challenge with the industry, whether it's you haven't been able to find certain products if you're shopping or shopping online, or maybe if you've ordered something online, the delivery date is pushed way out. A lot of these have to do with, and this exclusively has to do with the global climate in the supply chain. And I wanted to kind of take a look at what's been going on over the last 20 months or so. But before we kind of get into that, really where COVID came to prominence in the world, we can look even farther back for some aspects of the transportation industry that kind of contributed to some of the instability. So as we came into 2020, when we know the first rumblings of COVID were coming out of China, there were already some things going on in the transportation industry and global trade that were somewhat destabilizing. First thing we had going on was, and you may recall from the prior administration, the trade partnership between the U.S., Canada, and Mexico was formed. That was known as USMCA, replaced NAFTA, the North American Free Trade Agreement. And this was part of the prior administration's America First campaign and initiative to try to promote production and manufacturing for companies in the Americas. So they were trying to incentivize companies for producing in North America instead of outsourcing to trade competitors or competing markets like Europe and Asia. One other thing that also came about during the prior administration was the trade war with China, which was prompted by an investigation into China for unfair trade practices, primarily relating to technology and intellectual property and innovation. Now, China is our largest single country trade partner, only to be outdone by all of Europe. But when we conducted this investigation, the results prompted us to impose increased tariffs on certain commodities coming out of Asia and China in particular. Now, the amount of goods that we import from China is quite large. We import nearly $435 billion worth of goods from China alone. The additional tariffs on these commodities added a significant cost to our trade partners or to shippers and manufacturers in China, to the tune of about $50 billion. So that is cost added to their operations that they ultimately have to pass on to somebody, and that typically means that's going to come to us as consumers. So not only was there an additional cost to us, and that kind of that was something that was kind of I'd say an unfortunate reality, but it destabilized our relationship with China. China imposed some retaliatory tariffs as well. We don't export to China nearly as much as we import from them, so the costs that were relatively nominal in comparison to them. But then, once we kind of enter into 2020, this is when things start to go wrong. The WHO announces the first pneumonia-like symptoms in Wuhan, and of course, things got worse from there. And of course, cases rose. As cases rose, there was a significant drop in consumer demand, and businesses closed due to lockdowns and quarantines. Many jobs were lost because companies just couldn't remain solvent in that environment. Causes some of these services went unattended, so there were port facilities and manufacturers and transportation providers who did not have employees, so they couldn't operate. And so again, manufacturing stopped, port facilities and port operations shut down, and really functionally shipping stopped happening, it ceased. Ocean carriers, these large steamship lines, had to cancel sailings. A lot of them took ships out of service because that's a tremendous cost. So they actually put these ships into storage, more or less. Many ships were anchored offshore and outside of ports. Airlines also, as we know, there were many flights that were canceled. Airlines were grounded. A lot of people don't understand that about 50% of air capacity comes from passenger ships or passenger airplanes. So when you're flying to wherever you're going, when they put your luggage underneath in the belly of the plane, they actually put freight down there too. And so they do that. It's a quite significant amount that they ship in the belly. So, that was, that essentially went away. In 2020 alone, almost 75% of the air capacity, so that's available flights, was removed from the market. And whatever was left over was largely devoted to shipments of personal protective equipment, so PPEs and other medical equipment. In addition, truck operations essentially, sorry about that, truck operations essentially went away. There were a lot of trucking operations that went out of business. 85 to 89% of trucking operations are considered small businesses and have between 1 and 5 trucks. So when that's not a large business to sustain not large enough to sustain during a massive shutdown like this. So a lot of those went out of business. And then with little or no freight moving, no air, no ocean, truck shipments, everything was basically stopped. All freight was stopped. Everybody was looking for places to put their freight. So the warehouses and rail yards, port facilities, distribution centers were all over capacity. So they were really busting at the seams with freight. Now, moving along into just before the summer, then we started to see a bit of a resurgence in consumer demand, and really driven by online shopping and from online retailers like Amazon and such. People were not willing to go out, or they didn't want to go out and shop in person. So a lot of that shopping was being done from home, whether it was because they didn't want to expose themselves to COVID, or they just wanted to do that from the comfort of their home. They hit the online retailers very hard. Also with the approaching holiday season, that kind of just further contributed to that. Also supported by the stimulus, the federal government issued a stimulus package that put some money in the pockets of those people who maybe lost their jobs or were falling on hard times. That gave them some additional resources to kind of keep the economy going. But because of this, because of the demand for consumer goods, it made it necessary for the steamship lines to really mobilize all of their resources. So where all of the ships had been kind of in dock previously, the demand came back, so they put all of their ships in the water. In the industry, we say all metals in the water. So we were at nearly full capacity in terms of our transportation on the ocean. The airline industry was still limited. Flights were not moving. So that was capacity that we just did not have. But ocean was the most abundantly available mode of international transit at the time. There was still congestion in the ports. I mean, we had leftover congestion, so there's backlogs to get through. So really that did not get better, and still is a challenge to this day. There was a shortage of shipping containers, also a shortage of trucks. Again, labor shortages, companies who have gone out of business, trucks just couldn't come in to pick up containers from the port. They weren't coming from inland to deliver containers. So that was another huge challenge. Inland facilities like rail terminals, distribution centers were backed up. I guess it comes down to the fact that the ports were so congested, there's just nowhere to put freight, so they weren't accepting freight. So those goods stayed inland and just did not move. The ocean liners, because they were so backed up and still continue to be so backed up, where they were running at a delayed schedule, which is very uncommon. They were running at about a 6 to 7 day delay for delivery. So when they were supposed to show up at a port, they were literally showing up a week late. So in order to catch up, they were employing certain strategies that are pretty common in the industry, but certainly in the last 20 months or 18, 16 months have become a necessity, even though it's very inconvenient for us. But what they would do is they would literally skip ports where they're supposed to drop off or pick up containers. It's called a blank sailing. They would skip those ports and just move right on to the next port and to try to catch up and get back on schedule. They would also get into a port and they would unload containers, or they would, in order to speed up the turnaround time, they would not unload containers, and then they would also not pick up containers. So we ended up with a lot of containers in ports that weren't supposed to be there, and a lot of containers still on ships that weren't necessarily supposed to be there as well. Interestingly, because of the backlogs and because of the delays, the standard kind of transit time between Asia and the US on the ocean, which was about 40 days, is now at about 73 days. So we're looking at almost twice the transit time to get goods across the ocean. And so all of this also leads to this increase in demand. We have a supply and demand issue, and now the steamship lines are charging astronomical rates. What once cost about $2,200 to ship on average to ship a container now is costing $10,000 on average, and that's even more coming from Asia because of the demand from Asia. It's about $19,000 to ship from Asia to the West Coast. So all of this adds cost to the shippers, in the manufacturers, and all of this is cost that is passed on to the consumers. So you and I are paying for this for the kind of outfall of this market, and unfortunately, things aren't much better today. We still have huge challenges with capacity. We have more passenger flights, which is great, but we still have tremendous backlogs. Manufacturers and shippers are utilizing charters more so now, where they'll charter an airplane, like a full airliner or cargo plane, or an entire ship. So a container ship that could be 14 to 16,000 TEUs, which is a good sized ship, might be taken up by all Amazon freight or all Walmart freight or maybe Target freight. So these and tremendously expensive as well. But those are often the only way they can get high volumes of freight to the U.S., especially given the fact that we're coming up on the holidays, and they need to meet consumer demand. So, but we'll be paying for that as well. Sorry, I'm a little behind in my transitions here. So, what does the future hold? Well, we just don't know. The future is a bit uncertain. We've heard predictions that this market will continue for 6 months, and we've heard predictions that this market will continue for 2 years. So I think the mantra is sit tight, continue to do what you're doing. We really don't have any choice in the matter, but things will get better eventually. But we just need to keep moving forward. So we'll talk a little bit about some of the risk implications. We understand what's going on in the market. We touched on a lot of things that pose issues from a transportation perspective. Let's talk about a few things that risk implications that arise as a result of the market. First thing is concentration of risk or concentration of values. And for those of you who have taken any of Professor McNamara's classes, you may have touched on this to maybe at a very high level. But concentration of risk is a concept that relates to property that's in close proximity with one another. And the reason this is a concern is because of the risk for catastrophic loss that would greatly impact an organization. So with the shipping industry being in the state it's currently in, there's a significant risk of large loss, right? Because you have goods that are accumulating at ports and at different locations that perhaps weren't anticipated. And if something should happen at those ports, some catastrophic event, an organization would be significantly impacted. So what do we know about the current conditions? Volumes and demand is in excess of capacity. So when that happens, goods are unable to move. Container ships are behind schedule, average of 8 days or so. And so they're going to take measures to catch up, including, leaving shipments there that they were supposed to pick up. And this, this even assumes they can get into, if they're going to pick up or not pick up in a port, can they even get into a port? As Professor McNamara said, there's tremendous backlogs, container ships on anchor outside of ports to the tune of 60 or so in LA, which is the US's most busiest port. That's unprecedented and unheard of. So this creates a significant risk for an organization. Now, you might be wondering, what could happen in a port that, where we have a concentration of values? What's the worst that can happen? Well, Nathan Tims is going to show you some examples of what exactly could happen in the case of a catastrophic event. Nathan, you want to? I'll stop sharing.
我靠，哪地方炸了？我日！我靠，天都亮了！我靠。
This video is of the Tianjin
是哪儿啊？
port in China.
我操，明天要上新闻了。哇！我日，楼都在晃。
Huge explosion. And the shockwave. That was a warehouse that was illegally housing, storing ammonium nitrate, which is very, very explosive. Is used in terrorist bombings. If you remember the World Trade Center back in the 80s or 90s, they used ammonium nitrate to try to bring that down. Also, the Oklahoma City bombing. So it's used. It's extremely, extremely explosive stuff, as you can see. Obviously, this is at quite a distance, so it's hard to get some scale. I'll show you a couple pictures in a minute of the damage that actually that caused. You want to do the next one, Nathan? This is in Beirut, Lebanon, at the port.
Oh my God!
So as you can see, it's not unheard of that there might be something that could happen at a port that could destroy your goods on such a large scale. Clearly, that was a extremely catastrophic and harrowing event. In the explosion in Tianjin, you can see here the aftermath of both. This is Tianjin. You can see that over here. Those are steel corrugated containers that were crumpled like soda cans. You had buildings. This over here was a lot full of cars, or is a lot full of cars. Some buildings were completely destroyed. And this crater is, I believe it's about 150 meters across, if I'm not mistaken. 140 some odd people lost their life tragically in that explosion. And again, the people who lost, the companies who lost their freight or their goods here, they had nothing to do with what happened in that warehouse. They had nothing to do with a company who illegally was housing this very explosive material. Yet they were very clearly very affected by the explosion. In Beirut, you can see here similar thing. Very, very, very devastating effects. And not only was you have obviously direct impact, so you'll see the direct damage around. But if you think about the other implications, kind of further downstream for the companies or what have you, you realize that these can impact not only kind of on a direct basis, but on an indirect basis, certain services or necessities. This building here was a grain silo, and the people of Beirut import almost 100% of their wheat, and so and this is where they would be offloaded. So because this was completely destroyed, obviously there's nothing there to be used. What are they going to do for wheat? It poses a very dire economic issue for them, but also a survivability issue. What are they going to do? I'm sure there are other ways to survive, but this is going to add costs to their daily lives. They're not going to be able to get wheat to make bread, et cetera. So these are some of the things you should think about as if you're going into the risk management profession or insurance profession. That it's not just what's in front of your eyes that is the impact. It really is. It's much more far-reaching. Another thing another trend, a recent trend, is that ships are getting bigger, and this is a direct result of the amount of demand that's in the market. These ships, this is the largest currently. I believe there's 5 others being built by the Evergreen line. That will be its sister ships. It will be the exact same dimensions. The capacity on this ship is an astronomical, nearly 24,000 TEUs. So if you look at each one of those containers on the boat, those are most likely 40-foot containers. A TEU is a 20-foot equivalent unit, meaning that if there's a nearly 23,000 TEUs of capacity, there's about 12,000 or so of these 40-foot containers on a single ship. So concentration of values and concentration of risk can be catastrophic for a company, right? If something goes wrong. To give you a little bit of perspective on just the size of that, it's hard to really conceive it. But this ship here, sitting on its end, we'll put it next to the Space Needle, and we'll put it next to the Eiffel Tower. So I'd like you viewers to just on your own think about and guess what is the order of these 3 things from shortest to tallest. And I'll give you a second, and then I'll show you. So here's the ship, and here's the Space Needle, 605 feet. I was actually shocked by how short that was too. The Eiffel Tower, 984 feet. The Ever Given, or the Ever Ace, 1,312 feet. That means it's about a quarter mile long. So the scale of these ships is massive. And bad things happen on these ships too. Here was one particular instance last year, November of 2020. The ONE Apis was en route from Asia to the United States, actually going to the port of LA. where it encountered heavy seas and gale force winds. It lost almost 2,000 containers overboard and just lost in the ocean. And that, to give you some perspective, on average, any given year, there's about 1,300, 1,400 containers that are lost any given year. So on that one ship, we lost 1,800, more than any single year. What they think was the cause is obviously the weather, with very heavy seas and gale force winds. It's tough. A ship sustains a lot of pressure, it gets jolted and rolls, and that's a lot of force. But also, because this is such a large ship, you can see how tall those stacks are, those stacks of containers. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, maybe 15 containers high, very high center of gravity. Now, these are they're supposed to be meant to, when they're stacked up against each other, to give themselves some rigidity. But even with, because they are stacked so tall, because these ships are so big and they try to fit so many containers on them, it really couldn't have been helped. They were, they lost a lot of containers, and I know of at least 2 companies who lost more than 35 containers just themselves. So it can be very detrimental. And I also should mention that it is predicted, some predict, that these types of issues will continue to happen, and they attribute a lot of it to global warming. Now, whether you believe that or not, there have been a number of these similar instances over the last year. I think there's been more than 3,000 containers lost overboard in situations just like this. Now, this was the most catastrophic, but it does continue to happen. So there are people, professionals, engineers are looking at how to secure these better, to make sure that this doesn't happen. This doesn't happen anymore. Now, another thing that's happening as a result of the market conditions is shipping delays. Now, the shipments are being delayed due to the congestion, right? The volumes and congestion. And why is that an issue? I mean, never mind us being upset about not getting our product, our iPads or iPhones, PS5 or whatever it is. They can have really dire consequences to an organization. You can suffer a breach of contractual obligations, right? Which could lead to penalties. It could lead to, relationships being severed, which could ultimately have very long-term negative effects on your company, right? They could have, you could suffer reputational damage. Your public perception may be damaged if you're, through these delays. And obviously, it's much of this is outside of the control of companies, but it does happen. Shortage of essential goods. God forbid we couldn't get vaccines to those who need them. This is a real threat if we with these delays and the congestion in the market, and then also temperature sensitive goods. That could be anything from vaccines, that could be pharmaceuticals, that could be food. It runs the gamut. Some of these shipments are critical medicines. Some of these shipments could be, we have pharmaceutical companies that we handle freight for that have shipments that are in excess of $75-80 million, just a single container, and they need to stay at a certain temperature. So if these goods are not kept at a certain temperature, then they are not usable. They can't release them into the consumer to consumers, and perhaps those who really need them for life or death situations. It could be very, very dire for them. But these are, again, some things that we just a couple of risks that we see as a result of today's supply chain. I really don't have anything else in terms of the presentation. But Mike, I guess I'll turn it back over to you. And if you have, if you want to run the Q&A or what have you, but thank you for your time.
Very good. So you can't hear us, but we're all applauding. Maybe you can hear me.
Okay, but, I can hear you. Thank you.
Yeah, let's open it up for questions. I don't have any questions on the chat log yet. Students, please. Let me throw out a question. Who are the major insurance markets for, I would assume this is ocean marine insurance, and I've always heard Atlantic Mutual is the largest, but who are the major players in that market?
Yeah, great question, Mike. So there are several. It's a large market, but I would say the ones who would be considered major players in the supply chain insurance realm. I would start by saying just Lloyd's of London. That's where cargo insurance originated. They still do, have tremendous expertise in Lloyd's. I would say that Zurich is one that's very large, and we do quite a bit of business with. Allianz is one. Chubb Ace is one. Navigators, XL Catland, which which now is AXA. AXA is one of them. So there's a number of them, Mike. But the ones we work with are primarily the major insurers that are out there in the global market.
Okay, student Cole has a question. Nathan, from your perspective, is there anything that the government can be doing to help alleviate the backlog in shipping?
Yeah, it's a good question, Cole. So there's not a lot the government can do to help alleviate the backlog that I'm aware of. However, what I do know is the Biden administration has launched an investigation into the profitability of some of these steamship lines, because as I mentioned, the rates from Asia to the U.S. are now close to $19,000 on average, where at one point it was closer to $2,000. They see price gouging there, and they've launched an investigation. So the results of that are at this point unknown, Cole. But really good question.
Okay. Suresh has a question. In regards to the big ship shortages for cars, having cars that need repairs take so long to be worked out, or is it just the general shortage of chips? What's going on there with the chip shortages and the automotive sector?
So obviously, I mean, we know that there is a shortage of chips. That comes primarily from the sourcing of raw materials, but again, it's the supply chain that has kind of limited that, and then the manufacturing, and that was kind of shut down for so long. So yeah, that continues to be a real issue for new car production. But we also know now that if you're in the market for a used car, it's harder to come by a used car as well because of that. The challenges on the new car market. There are some companies, some major manufacturers like Toyota, for example, that kind of foresaw, maybe they didn't foresee this coming, but they knew that this was possibly a risk. So what they did is they actually overproduced chips, and they put them in storage. And so they aren't quite having the same challenges as other manufacturing. So it was quite well done on their end, having that kind of foresight and planning from a risk management perspective, seeing the risk of not having those types of components ready to go when they need it.
Yeah. Arrington has a very thoughtful question here. I'll just read it. Earlier, you mentioned that China exports more to us than we export to them, and how that affords them leverage when imposing tariffs. With the U.S. having the largest economy and being by far the world's largest exporter of food, do you ever question this dynamic? Is it right that electronics and consumer goods are valued more highly than food? Are there other ethical implications of global trade that you personally wondered about throughout your career? Great question.
So that is an interesting question. Yes, we do. We export to the world, China and the world. We export a lot of food. Gosh, that's a great question. I'm going to go ahead and read that again in the chat because I want to make sure that I hit all of the points. How it affords them more leverage when imposing tariffs. I'm sorry, I have to read this over again.
As I said, it's a very thoughtful question. Thank you.
It is.
Yeah.
It is. Gosh, I have to say, I mean, maybe I shouldn't admit this, but I guess I haven't thought about the ethics behind the way that the global trade works, and if there's disparities in in our kind of how I guess how successful or how large or how economically powerful we are, and if that has in any way is unfair to the rest of the world, should we be should we be more charitable in our, or what have you. I honestly, I wish I had a better answer for you. I'd love to take that away though, Mike, and maybe give that some thought, and I'd love to respond to that question, perhaps in writing, if that's all right.
I will share it. Arrington's in my risk management class.
Really good question.
Gatlin has a good question. Were the companies compensated for the destruction of their buildings and supplies? You showed those explosions. So were companies compensated?
So companies would be compensated. So if they had, let's say their property was directly destroyed as a result, if they were insured, then most likely that would be an insurable risk. That is a pretty common tenet of property insurance, that if there is loss or damage, then that would be considered a trigger for coverage. So yes, I would assume that that property insurers would pay for not only the direct loss, but many property insurers will pay for any economic losses as a direct result. What they call time element coverages. So it'd be loss of income or additional expense. In terms of the warehouse owners that were actually storing these goods, they're certainly going to probably be in jail if they're not already, because this was in China, I believe in Tianjin, I believe the owner of that location was arrested. I don't know about Beirut. Time will tell how that will shake out. I'm sure insurance companies will pay for their customers' losses and then perhaps go after the insurance of that warehouse owner. But there is certainly liability there. Yes, hopefully those companies that were affected were insured, and will get duly compensated for their loss.
Very good. We have a question from a faculty member, Professor Sung An, in my department. Is curious about the insurance premiums, the reinsurance premiums. I'm sure he's getting at the hard market, and how the premiums are assessed. Is it by cargo container? Is it by the content? And when does the risk manager, when does the company become responsible? When it's placed on the cargo ship, when it's taken off the cargo ship, those types of issues.
That is a great question. So it really depends on what. So if we're talking about goods in transit, let's look at this two ways. Goods in transit. So what would be considered cargo insurance, and let's look at like static property insurance. If you have a shipment that's being shipped from an origin to a destination, there is a set of what they call Incoterms, which is international commercial terms, right? So there's basically shipping terms that define who's paying what between two parties, the seller and the buyer, who's responsible for arranging the freight, who's responsible for paying, and who's responsible and who has the risk of loss. And usually that cargo insurance will start from the time it leaves. It's defined by the Incoterms, but it generally it covers the goods from the time it leaves the origin to the time it arrives at the named destination. If it happens in that time frame, then if there's loss or damage in that time frame, that would be considered cargo insurance, a cargo insurance risk. So it'd be insured by a cargo insurance policy. The way they assess or they kind of evaluate the coverage for that and determine how much will be paid is before that shipment even leaves, they'll determine, if it's an annual policy they're looking at, an underwriter will take certain information like what are the commodities that they're shipping? Are they high risk? Are they lower risk? They're going to look at the average value of a shipment over the course of a year. They're going to look at the maximum value of a shipment. They're going to look at how much volume or how much value are you shipping during the entire year that they're going to be insuring. And then they'll look at loss history and things like that. If they've had claims in the past, and they all kind of take this all into consideration when coming up with price and coverage. So if you have established that you have a certain shipment that, you'll have coverage up to a certain amount, you may, if you have, let's take it as an example, if you have $100,000, if you're shipping $10 million during the course of a year and your average value of a shipment is $100,000, but you might ship something that's $1 million at some point, you'll have $1 million limit in case you ever hit that limit, and with a loss, you'll get paid by the insurance company. But underwriters will take into account the average value of a shipment, of $100,000 when determining pricing. Sorry, that's really in the weeds, but I think I answered part or most of the question.
You did. Matt Williams, who's the president of our Risk Management Insurance Advisory Board. I should mention to the students that Nate is a former president of our Risk Management Insurance Advisory Board. Matt ties together a couple issues with his question. Can you speak to supply chain issues relative to cyber attacks, which I think is an interesting question? Yeah,
Matt, great question. And really, really topical because it not only has been an issue in the last few years, but it continues to be an issue. So there have been a number of cyber attacks on large steamship lines. The Maersk had one a couple of years ago, the NotPetya attack that damaged basically all their computers, and they were offline for I think more than a week. But it just created bedlam within their company and within their kind of supply chain, both upstream and downstream. Shipping companies are very susceptible and vulnerable to cyber attacks. And the reason for that is, you heard me mention before that 85% of trucking companies out there are small businesses, right? Maybe even mom and pop shops. And these steamship lines have to work with, and they share systems with these small outfits. These small outfits are not going to have the same level of cybersecurity as a large company like Maersk. They're just not. They probably can't afford it, and even if and they probably aren't savvy enough to really manage that. So there's an entry point there, Matt. That's where because Maersk is going to work with hundreds and hundreds of service providers, they're at tremendous risk for this, and that's exactly what happened. So again, the shipping industry is notorious for this type of there's a lot of small businesses that are involved, even with the largest companies. I think there's been some reform. I think there's been they've recognized that this is a challenge. So I think they're putting more resources and more time and effort into this. However, there are emerging risks all the time that are really hard to anticipate. For example, there are foreign actors, bad actors in Russia, in China, elsewhere in the Eastern Bloc that have successfully taken over the steering system, basically the navigation system for ships. And one in particular was in the Mediterranean. A captain lost control of the ship for 9 hours. This was a couple of years ago. And they don't know where they were heading to, but they couldn't get control of the ship. They actually had this helicopter in a team to regain control of the ship. The risk there is that, that could be, that ship could be steered anywhere. It could be ran aground. That would make it, vulnerable to pirates or what have you could come on and, either take the crew hostage and demand ransom or even steal physical goods. But it's a really scary prospect that they could actually take control of the ship. And there's been other instances as well. There's been spoofing incidences with GPS where a hacker could hack into a GPS system for a ship and essentially change the trajectory a half of a degree, and the captain would think they're still going straight, but they would actually be going off half a degree, which if you're going over long distances, which could be miles and miles and miles off of your intended course. It's things like that kind of keep me up at night, not knowing what the next cyber attack is going to be.
Yeah. Do we have any other questions from students? We've been through the questions in the chat log. Maybe we can take one or two more questions. I'll throw one out while we're waiting to see if there's any more.
Sure.
This came up during the practice that we did on Friday afternoon. Has the backlog with the ship that ran aground in the Suez Canal, has that been cleaned up yet, or is there still a backlog?
Yeah, the backlog is long gone, but that was a disaster. That was the Ever Given that got lodged in the Suez Canal. It was there for, I can't remember the exact duration, but there were, dozens and dozens and dozens of ship piled up at either end. I'm not prepared, Mike, with all that, the specific information, but that they ended up, the Egyptian government ended up seizing that ship once they got it dislodged, and essentially held it until they would pay their $900 million fee for clogging up the Suez Canal, which wasn't because of damage. It was actually that amount that they determined was their economic loss. So the company or the government who runs the Suez Canal, they charged for ships to go through it, and that's how much they lost during that time period. So they were holding the Ever Given and the Evergreen steamship line responsible for that amount before they would let them go.
Okay. Our final question is from Bashir. How does the Suez Canal stoppage compare to the port explosions in Beirut and China with regard to supply chain backlog?
Yeah, that's a really good question. And I don't have an answer about how Tianjin or Beirut, what kind of backlog that created. Certainly, the Suez Canal created a tremendous backlog for a certain period of time. It took a little time for them to unclog it, but the economic loss was huge, and there were Again, I don't have the specific data on it off the top of my head, but there were ships that were delayed, and certain commodities couldn't get. There were shortages as a result of them not being able to get to their destination. In Tianjin, that's one of the busiest ports in the world. China has like the top three, I think, of the busiest ports between Shenzhen and Shanghai. Is it Shanghai? And Tianjin. Certainly a lot of that, that traffic that was routed to Tianjin could have been rerouted to other ports in China. And that's, I guess, one of the benefits of having, being so, having so many ports there the Pacific side. But certainly the fallout from there's no comparison between Beirut, Tianjin, and Suez Canal in terms of just the total overall impact with lives lost and such.
Yeah. Nate, two quick questions. We have one from Jean Young, who's with the WSU Risk Management Department. As Expeditors, do you have any ownership interest in the cargoes that you ship?
Good question. No, we do not. We're as a freight forwarder. No, we don't have any interest in terms of ownership. Certainly, we want to deliver our customers' goods in one piece as they're intended. We do adhere to international conventions and laws as it relates to our liability as a carrier, though. There are certain international conventions and laws that are developed specifically for carriers of freight to make sure that if in the off chance that something is damaged or lost in transit, that we're not paying the full value of those goods, right? Because the fees that we charge are nowhere near what of any given shipment would be valued. We charge based on weight and dimensions of cargo. We don't charge based on the commodity. So whether it's a container full of iPhones or a container full of ball bearings, right? A huge disparity in value, but we charge the same. Our fee is going to be the same. If they weigh the same, we're going to charge the same. We can't be expected to reimburse Apple for a container of iPhones that we lost or damaged, or they damaged while in our carrier's possession. So our liability is significantly limited in those cases. And these were, these conventions, they date back to the early 1900s when, these containerization of freight, when, air freight started becoming more common. It was a way to sustain and make sure that transportation companies would stay solvent because they knew that it was critical to the global economy to have affordable and sustainable transportation. So they couldn't risk having a transportation company go out of business because they had to pay some exorbitant liability. So that's why those conventions were initially drafted, and that's what we adhere to.
Yeah, and a short answer, and this is again from another former president of our advisory board, Carla Pittman. What are the key exclusions in cargo insurance? So we're kind of running out of time, so please keep your answer short.
Okay, great. I'll tell you, there in cargo insurance, Carla, there are. So if you're looking at the Institute Cargo Clause A, American form or English form, it basically what that is all risk insurance, right? What that means is your cargo is going to be covered unless it's specifically excluded. Of course, loss or damage is a covered trigger, but there are certain things that aren't covered, like a delay, the economic impact of a delay, right? If you lose a sale, the insurance company is going to pay you for, unless your goods were lost or damaged. It's not going to pay if you didn't package it appropriately. It's not going to pay if there's a nuclear explosion, and things of that nature. So there are a few areas where there are limitations in the cargo insurance policy, but by and large, it's a very, very broad policy, and you'd have to be, it's rare to find something that happens that wouldn't be covered.
Yeah. Nathan, thank you so much. This was quite an interesting presentation. You can't hear us, but we're all applauding you now for the presentation. Usually we present some gifts to our speaker. So I hope they arrived in time.
They did. And let me tell you, I'm very excited about this as well. I mean, and this is very beautiful as well. Thank you.
Very good. All right.
And the sweatshirt. Thank you very much,
All right.
Professor McNamara. I greatly appreciate it.